2022 was the year that demolished the science fiction fallacy of MMT, the modern monetary theory that is not modern and is not a theory. Printing money like there's no tomorrow and destroying the purchasing power of the currency to favor bloated governments is something that has been implemented for centuries all over the world. There is nothing modern about that theory, and certainly it is not a theory. What happened in 2022 was that just a few rate hikes from the Federal Reserve showed that the idiocy of sovereignty, monetary sovereignty, that was repeated all over by the MMT defenders is inexistent. That monetary sovereignty is not something that a government decides, and certainly not something that is permanent and that allows a government to do whatever it wants. That monetary sovereignty only exists because you and I, we, all of us, accept the currency as a means of payment, as a reserve of value, and as a unit of measure because we have demand for it. Currencies, like any other good or services, are subject to the law of demand and supply. And no, the government cannot increase its debt as much as it wants, even if it is monetary sovereign. We have seen the debacle of the yen that made the Bank of Japan U-turn in its yield curve management policy. We have seen the pound almost go to lead the Bank of England to a crisis because of a completely misguided budget that increased massively the spending and the borrowing with it, alongside some tax cuts. And we have seen how even the United States, with the almighty US dollar, had a massive destruction of the purchasing power of its currency, and with it the salaries and the savings of citizens because of a misguided view of monetary policy. The reality is that money is something that we need to take care, and that sound monetary policy is essential to maintain strength of the economy and to maintain productivity and growth. Printing money is never neutral. Printing money always disproportionately impacts those first recipients of money, governments and the highly indebted, and hugely, massively and negatively impacts those that have wages and those that have savings in deposits. No, when inflation soars, workers do not receive higher wages. We have seen in 2022 how even strong economies have seen real negative growth in wages, and it is absolutely false that governments can increase their spending as much as they want and their borrowing without consequences. Inflation happens, and when it happens, it is nasty and it impacts you. Of course, the MMT defenders will not suffer it. The prospects for 2023 in terms of earnings are not good. The market, according to Morgan Stanley, is already discounting an earnings recession similar to that of 2008 and 2009. What is an earnings recession? An earnings recession basically is when the companies see their earnings come down, not just in terms of EPS, earnings per share, but in terms of operating margins and operating income. That is a generalized weakening of the growth of the businesses of most of the companies. Furthermore, the problem of an earnings recession is that it happens at a time in which the elevated valuations that were built on easy money are not going to be there anymore, i.e. we cannot expect multiple expansion in an earnings recession with higher interest rates and at the same time monetary constraint from central banks' reduction of the balance sheet. Therefore, right now, if we look at the estimates of earnings for 2023, they're still optimistic. But we need to look particularly at cyclicals because commodities have been correcting. Second, because the global environment is weaker. Third, because it's virtually impossible for businesses to keep their margins in an elevated inflation environment like the one that we're seeing right now. Let's pay attention to that earnings recession because that is nasty and it means that we need to pay a lot more attention to valuations. The reason why you need gold in a portfolio is not because you think that there's going to be a recession or because you think that there might be some weakness in the economy. The reason why you need gold in a portfolio is because with the level of correlation of risky assets, you need decorrelated assets that are going to provide some cushion in times of volatility. Many people say that gold has not worked in 2022 because the dollar has strengthened. But if we look at gold valued in euros or in yen or in pound, etc., it has actually done significantly better. At the end of the day, it makes absolutely no sense for anybody to look at gold in a currency that is the world reserve currency, because that is not the way in which you have to price gold. The way in which you have to look at gold is how demand and supply are working. And the reality is that global demand for gold is rising and rising significantly, while supply is much tighter. So you need to have gold because we need decorrelated assets. Did the Fed really tell us that it's a good moment to buy bonds? We're not very sure, because if you think about this, right now, bond yields have improved, which has created some demand for bonds, considering that central banks are going to stop hiking rates in 2023 and that inflation is going to come down very quickly. However, inflationary pressures continue, and even the most benign estimates coming from consensus still see 3 to 3.5% core inflation in 2023 in the euro area and the United States, which means that central banks are likely to continue to hike rates, but more importantly is that it may mean particularly that bonds might not be as adequately priced as we thought because of the current levels of bond yields. Basically, what it means is that we would need inflation to go down to 2% quickly in order to accept the valuation of high-yield bonds at levels that move between 5 to 7%. Not easy to believe. Estimates of inflation are coming down. However, those estimates of inflation include very strange bets. To start with, what we are seeing from consensus is, on the one hand, expectations of a global growth that is slowing down but is not in recession, while at the same time, an improvement in most of the commodities that would benefit emerging markets, and for some strange reason, everybody's expecting inflation to come down. So how can you bet on emerging markets that depend on commodities and depend on the inflation in prices of commodities while at the same time expecting inflation to come down? There is a very strange situation in which many of the strategists are betting on one thing and the opposite at the same time. They are betting on central banks maintaining their policy only until June and then quickly changing it and U-turn in their policy, while at the same time they expect commodities to recover and they expect emerging markets to do very well. Very difficult, isn't it? So what we need to do is to monitor that situation, because at least what we would need to do is to bet on something that is consistent. And consistent would be that if inflation remains elevated, which is quite likely, particularly in core inflation, and central banks maintain their rate hike path, it is very unlikely that the growth of emerging markets is going to be as robust as the one that we have in the current landscape of consensus estimates. Furthermore, it is very unlikely as well that their exports of commodities will thrive as some expect, and therefore the other problem is monetary. We'll pay attention to that. Is 2023 a year for emerging market currencies? We have seen an improvement in at the end of 2022 because the dollar has sort of weakened a little bit. However, what we need to understand is that the weakness of many of the emerging market currencies is done by design. It is not something that has happened due to some strange reason that nobody expected. So let's think about one thing. First, are governments going to stop spending massively in local currency? Unlikely. Two, are their central banks going to stop printing local currency? Very unlikely. Three, are those citizens of those countries going to accept their local currency in a higher way and save in local currency, invest in local currency? Highly unlikely. Think about this. Demand globally for local currencies in emerging economies is not going up, it is going down. Furthermore, their imbalances in dollars are rising because they add a fiscal deficit to a trade deficit. So I would be extremely, extremely cautious about those that expect the Brazilian real, the Colombian peso, the Chilean peso, or the Argentine peso to strengthen in 2023. And at best, I would pay attention to the currencies of the Asian countries in which the monetary policy is not as aggressively oriented to bloat government spending and pass the inefficiencies to citizens. Global oil prices are weakening, and one of the things that we have seen is that the curve has gone from backwardation, which is bullish, to contango, which is bearish. And we need to pay attention to it because in 2022, a large proportion of investors globally have bought into energy companies due to the expectations of ever-rising commodity prices and higher demand. Those things are not happening, and it's very possible that what we see is very significant earnings downgrades. We mentioned before the risk of earnings downgrades, and it's very likely that we see more, and in the more cyclical sectors, because the commodity prices are correcting, and at the same time global demand is weakening. So if, as consensus estimates show, oil giants are expected to have a realized oil price of between 72 to 75, consensus will probably have to bring down their estimates by about 10 to 15%. Pay attention to that. Banks all over the world have survived the period of negative rates in a very, very good way. We have seen core capital improve. We have seen, in general, the strengthening of the balance sheet of the banking system, particularly in the Eurozone, but also in the United States and in the global banking system. However, in 2023, we need to pay attention to the wall of debt maturities that are coming. We need to pay attention to how the issuers will be able to repay those debts, the increase in non-performing loans, and although rate hikes certainly help banks, we need to also pay attention to the balance sheet and how those banks will have to conduct significant provisions. Provisions are very important because they might be enormous, not just because of the weakening of solvency of some of the companies or people that have taken those loans, but also because of the valuation in the market of the assets that banks have. So if the European Central Bank expects banks in Europe to undertake very significant provisions that could take up to 12 to 15% of their earnings in 2023, think about what would happen globally. The global debt maturity wall is facing the global rate hike, and that clashes with rising non-performing loans and certainly much higher provisions. Let's pay attention to that.